Good evening. This is Ken Long at Tortoise Capital with a review of the weekend trading report for January 21st, 2018. Market is in bullish volatile conditions on an annual basis using weekly RSI 14. We remain deeply overbought at 90 out of 100. The shorter term look back using the 10-day NDX, we are thoroughly overbought at a score of 100 on that indicator. Looking at the market mosaic, the price relative to the 200-day moving average and the slip of the 50-day moving average both got stronger for the bullish case. Both are green bullish. ADX is an extraordinarily strong 41.3 with the bulls in charge. The risk index is the 30-period moving average of the VIX divided by the 10-period. The boundary between risk on and risk off is 1.0. That current reading is at 0.943. So we just moved into risk off this week after an extended long period to the upside with an increase of volatility in the short term. We take that score of 0.943, compare it to the last 5,000 trading days, and compute the risk Z, which is how many standard deviations below the long-term average that indicator is. It's currently reading at minus 0.75. These periods of time right here really favor short-term volatility-based trading. Lots of intraday stuff is springing up. It's a good way to hedge the long positions, which were earning good swing trades during this entire period of increasing higher lows, and then when that indicator is in the green. So this is the time to be hedging and taking advantage of short-term, sharp intraday moves. You can see the leaders in the blended monthly rebalancing as of the close on Friday, and then the holdings that we have through January with the reevaluation due on or about 1 February. ETF2 remains at a theoretical exposure of 100% with all the indexes in pretty good shape. These are a quick look at the ranking stats on the blended monthly rebalancing across a number of different portfolios. The ETF 13 with the diamonds and the Qs, Japan and US large cap in charge. In ETF 32, we take that same basic set and add a few more to give us deeper diversification. You can see China made a nice rebound this week, along diamonds did fairly well as well. Some strength came in Brazil and Latin America and staples, and 20-year treasuries, energy select, and industrials both gave back a little bit. Among the Dow 30, Boeing, Caterpillar, United Health just had an extraordinary week, as did Merck at the bottom of the stack. So this could be very well a turnaround play here in Merck. I'm looking for more momentum out of Merck. GE just got smashed this week. I'm riding to the short side, but I'm also being prepared to buy quality on sale, which is what you get. You get opportunities when things are this extreme compared to the rest of the Dow. So GE is a special case that deserves our attention. American Express also in that same category. The beginning of a downtrend on something that has been long-term below average. Sector spiders, some gains this week in technology, healthcare, and healthcare equipment, along with consumer staples. Retail did fairly well. Some givebacks here in the energy sector after a long period of outperformance. ETF Max, these are the symbols that have done the best out of a stack of 500 ETFs, sorted by the blended percentage of 3 and 6 months. And you can see a lot of those leaders were taken to the woodshed this week. So is that an opportunity to buy quality on sale, or is that the beginning of a rollover in the market? Too soon to tell. I'll be taking advantage of the shorter term increase in volatility in order to hedge long positions and to take advantage of that uncertainty. Meanwhile, I'm looking for who the new emerging relative strength leaders are, like in this case, China Financial, South Africa, small cap healthcare, and as previously mentioned, Brazil, Latin America, and Mexico. Here's the health check of the S&P. This increase here in the daily ranges is contributing to the volatility, and then a couple selling days closing with a doji. You notice that the slope of the 30-period regression line is still at an extremely high 0.56, meaning this last 30 days of gains are just off the chart amazing. These red horizontal lines represent support levels that used to be resistance, and if this cracks, these are the targets on the way down. The dragon remains on the edge of the river. The river is expanding. The slope of the 30-period Bollinger Band is strong. The 10-period regression channel is up, extremely strong. The 30-period is up. And the jaws of PPO after 3 good signals to the upside remain open. So it's only the short-term volatility spikes associated with closure of the government and some other shenanigans that are offering any kind of tremors to the market. So it's still well postured for resumption to the upside, but we frame trades in both directions, and so we are aware of the downside support. ETF2 regional report, everything's on a buy signal. That's price relative to the 4-month moving average. Market is bull volatile. The S&P at 42 is stronger than EFA at 37 under the strength, and so the U.S. is still to be preferred to the globals. Inside the U.S., it's technology, then large caps, then mid caps, then small caps. The two strongest sectors, U.S. tech at 48 and Japan at 48. And then the two weakest sectors, Asia less Japan and the European 350. Inside the U.S. sector spiders, real strength here in energy and discretionary. Utilities have been just absolutely thrashed. Again, I think people looking to buy some income and yield are going to be starting to snap those up here at some point. So I'll be stalking that. U.S. is generally above average. That's the Dow doing exceptionally well. China exceptionally well. Mexico has made a turnaround. It's starting to look like a pretty nice swing trade. It's getting, even though it's reading 14, that's a deep value play that is starting to perform well. Oil is at the end of a long run. You can see oil of various types and energy services continue to dominate, but now some new leaders here in the green and white, South Africa, China discretionary, and giving up some strength here. White and green would be technology and financials, so we'll keep our eye on those. Daily liquidity stats to find the most liquid and the most volatile for intraday trading. That would be your VIX, gold miners, oil production, and biotechs. Shifting to the daily, a handful of signals. AXP on the overreaction, Disney and IBM on 551W. Autoframer has half a dozen that test out well. Notice Boeing had a pullback, and now you may be able to get back into Boeing on a tactical basis. GE has just been getting crushed along with AXP. Both test out better than 2 to 1 on the Autoframer. They're the leading candidates under max pain range compression. AXP is also an overreaction signal short. You see the relative strength leaders down here, UNH, CAT, and Boeing. Now, Home Depot quietly made all time period highs on the 100 or on the 10-day, 1 month, 3 months, 6 months, and 12 months. So a real breakout with strength in Home Depot on a quiet basis. So let's add that to our list of relative strength leaders. In the ETF 30s, treasuries, utilities, and real estate you see getting crushed. Brazil and oil have been strong, but now I want you to notice that the IWM coming back a little bit on Friday, and Brazil starting to outperform after a long period of underperformance. The daily pinch and stretch, again, the most positive of these stretches. These are the excursions above the middle of the river on a percentage and statistical basis. These are the stretches below the river. Notice utilities, General Electric, AXP, and real estate just getting smashed. The expanded pinch boxes, the stack, these are ones where the river is wide, which you get from having 30 days of directional outperformance. And so XLU is wide, exceptionally wide, and it's exceptionally stretched below. So that tells you it's been an enormous directional adverse move in utilities. And then the most compressed pinch boxes right now, only McDonald's. And this is where the river is exceptionally compressed, and so it's postured for a breakout. We've already started to see the breakout here in Apple and Procter & Gamble. And that's everything I want to cover for this week. And that stretch above the 200 just shows you the power of this recent move here in January. And the stretch of the slope of the 30 continues to continue gain. So this is a historically remarkable move. This is already like the fourth steepest 30-day period in the last 10 years. So this is becoming quite extraordinary. And that reversal can be very sharp, as we see in here. Notice from this reversal how adverse it became. So this is where that being prepared for volatility spikes is useful. You can see how that volatility spike manifested here lately to make this a volatile market. The 10 rolled over, but the 90 and the 30 still remain well above the 1.0 in terms of the slope stat of those regression lines. Notice how the river's getting wider. This is a dragon in full-throated roar. So that's why I'm prepared for volatility. And that's everything I want to cover today. It's Ken Long at Tortoise Capital. Keep your risk measured and your powder dry. We'll be doing a separate review in detail of the swing trade portfolio for the advanced swing course. There's still time to join. We'll be going much deeper in detail, looking at specific daily adjustments to our open positions and new entries. Take good care, keep your risk measured, and your powder dry. Go Eagles.